You've probably seen the headlines about cryptocurrency. It's this world of, overnight millionaires and then these sudden dramatic losses. It sparks a ton of debate. So, what is it really all about? Let's dive in and break down the fundamentals. You've definitely heard names like Bitcoin, Ethereum, and maybe even Dogecoin. They're all different types of cryptocurrency. And really, they sit at this fascinating crossroads. Some people see them as just a high stakes investment, while others truly believe this is the future of money.
But that gets us to the main question, right? What exactly is cryptocurrency? In this explainer, we're going to cover the basics, what it is, the technology that makes it all work, and of course, the potential risks and rewards.
Okay, so at its very core, cryptocurrency is digital money. The name itself is actually a great clue. Crypto refers to cryptography. That's the complex encoding used to keep everything secure. And currency, well, that just means it's a way to exchange value. Unlike the cash in your wallet, it only exists in the digital world.
So you might be wondering, how is this any different from the money in my online bank account? Well, the key difference is all about control. Traditional money is centralized. It's managed by banks and governments. Cryptocurrency, on the other hand, is decentralized. That means you and the network are in control. You can send money directly to anyone, anywhere in the world, without a bank in the middle to approve it.
The whole thing started back in 2009 with the very first cryptocurrency, Bitcoin. The original idea was to create a new kind of digital cash, one that was totally free from government control. But over time, its main purposes kind of shifted because the price can swing up and down so wildly. Most people now treat it more like a high-risk investment instead of a currency you'd use to, say, buy coffee.
But wait a minute, how can a system with no bank, no central authority actually function? Well, the answer is a really clever technology called the blockchain. It's what creates a secure and transparent system for everyone to use.
The easiest way to understand the blockchain is to picture a shared digital notebook. Every single transaction is a new entry written into that notebook. And here's the crucial part. Everyone on the network has an identical copy. Once an entry is added, it's there forever. It cannot be erased, which makes the entire history of transactions completely transparent and incredibly secure.
So here's how that works in 4 basic steps. First, when you go to send crypto, your request is broadcast to a global network of computers. Then, these computers all race to solve a really complex math puzzle to make sure the transaction is legit. The first computer to solve it gets to add your transaction as a new block to the chain, linking it permanently to all the transactions that came before it. So why would people dedicate all this powerful computing power to solve these puzzles? Well, there's a big incentive, a reward. This whole process is called mining, and it's what keeps the entire network secure and running. When these miners successfully validate a block of transactions, they're rewarded with brand new cryptocurrency. And that reward system brings us to the topic that gets the most attention, investing. While crypto was designed to be a new form of money, its constantly changing value has turned it into a major financial asset. But the potential for really high rewards comes with an equally high level of risk. To really understand the potential here, let's just look at Bitcoin. If you go back to 2016, you could have bought one Bitcoin for about $500. Back then, it was pretty niche, known mostly to tech enthusiasts. Now, fast forward to its peak in more recent years, and that exact same Bitcoin was worth over $60,000. I mean, that's just an astronomical return. It created incredible wealth for some of the early investors, but this growth is definitely not a straight line up. The volatility can be absolutely brutal. For example, say an investor bought Bitcoin at $45,000 in May of 2022. By December of that same year, they would have watched its value plummet all the way down to just $16,000. That's a 65% loss in just a matter of months. So why these huge, wild swings? Well, a massive factor is just pure speculation and media hype. Positive news can send prices soaring, while just a rumor of government regulation can cause a major crash. Unlike stocks, crypto prices are often driven more by emotion and market sentiment than by any underlying fundamental value. Okay, so with all that in mind, let's zoom out for a second and look at the big picture. What are the fundamental advantages and, of course, the disadvantages of this technology? On the plus side, the advantages are pretty compelling. Decentralization means no single company or government is in control. It's globally accessible. Anyone with an internet connection can use it. Transactions can happen 24/7, often with lower fees, and it can offer more privacy than traditional banking. And of course, there's always that potential for huge investment returns. However, the disadvantages are just as significant. The extreme volatility makes it a super risky asset. Its privacy features can be exploited for illegal activities, and governments are still trying to figure out how to regulate it all. And then there's the scams and fraud. But here's the biggest catch, and it's a really important one. There is zero consumer protection. If your funds get stolen or you accidentally send them to the wrong person, there's no bank to call. The transactions are final.
So to actually use cryptocurrency, you need what's called a digital wallet. Now, this wallet doesn't really store the coins themselves. Instead, it stores the keys that give you access to them on the blockchain. You get a public key, which is like your email address that you can share with people, and a private key. Your private key is the most critical part. It is the secret password that gives you and only you control over your funds.
All of this brings us back to the ultimate question, doesn't it? Is cryptocurrency a financial revolution in the making, or is it just a highly volatile gamble? Understanding the technology, the risks, and the potential rewards is really the essential first step for anyone even thinking about navigating this complex new world.